Now, India's GDP growth rate fell to its lowest in 5 years. Consumer spending was on the decline. But what is the information that has come in since then? What do we know about the next quarter, which is the July to September quarter? Joining us to talk about the state of the economy is JPMorgan India's chief economist, Sajjid Chinoy, joining us from the sidelines of JPMorgan's Investor Summit. Sajjid, thanks for joining us on Bloomberg Quint. Let me just first ask you what you see in the data since we got the GDP release. It certainly looks like sentiment has soured, but has data worsened as well?
Well, the hope is that, the worst has been seen, but I think any cyclical recovery is going to be gradual. I think the August data was not particularly encouraging. The PMIs were lower. If you look at exports and imports sequentially, they've contracted. And non-food credit growth has also slowed, which is a surprise given that, there's now sufficient interbank liquidity. The RBI is on an easing stance. So I don't think that the bottom has been reached, at least as per the August data. But I think for the quarter as a whole, we would hope that growth, picks up a little bit above 5%. I think we have to brace that this is going to be a modest cyclical recovery. For me, the key is going to be when consumption comes on stream, because I think what we're in the midst of right now is a lot of risk aversion on the part of households. Some of this, I think, has to do with sentiment, which could reverse quickly. But some of this has to do with the fact that they've run up a fair amount of debt in the last 4 or 5 years. A lot of household consumption has been financed either by running down savings or taking on debt. And when you go through that process, every time you're hit by a shock, if the shock sustains for long enough, households can recalibrate future income expectations and therefore consumption. And therefore, coming out of that process could be a little bit slower and take a little bit longer than we'd otherwise like.
Sajjid, this fall in bank credit growth seems to be interesting because there's ample liquidity. What's behind that?
I think it comes down to risk aversion. What you're seeing is when you are, in the midst of a 3-4 quarter slowdown and sentiment turns adverse, all economic agents, whether it's households, firms, financial intermediaries, tend to become more risk averse. I guess what banks are thinking is they've just come off a bruising NPA cycle. And to the extent that growth has slowed and credit risk perceptions have increased in the economy, whether it's households, whether it's small, medium enterprises, banks at this point don't want to take undue credit risk. So I think that's what explains why the transmission through of RBI rate cuts has been less stellar than all of us would think. Some of these, of course, are technical issues, liquidity, small savings rates. When there is movement back from shadow banks to regular banks, financial conditions tend to tighten. So there clearly are some technical reasons why transmission has been weaker. But I think some of this comes down squarely to risk aversion on the part of banks.
The other incremental source of worry is declining pricing power. The WPI data showed zero inflation on the manufactured goods side. Is that worrying?
That's right. I mean, and you don't even have to look at the WPI data. Just look at the CPI data. If you look at the August CPI print, core inflation, which is what we track, month on month was very soft, and all of the increase was essentially gold. If you take gold prices out of core, month on month, we're essentially, tracking zero. More broadly, if you step back, you can clearly see that output gaps have opened up and pricing power has reduced because the annualized momentum of core inflation was running at 6% in the last 6 months of 2018 and is running below 3% in the first 7 or 8 months of 2019. So when you have such a large fall off in a matter of months, it suggests that there is clearly a cyclical component to this. Output gaps have opened up, pricing power has reduced. But it's easy to get caught in a spiral of gloom and doom. You have seen in the past that when some of these downturns are driven by sentiment, things can bounce back also meaningfully. I mean, one simple example is I think a lot of households have postponed demand for autos, for example, or other consumer durables because they think GST cuts are coming. Now, hopefully, once that uncertainty is resolved at the GST meeting this weekend, then households, won't be incentivized to further postpone their consumption. So hopefully there'll be a little bit of good news there. The other thing is the global, oil prices have retreated from their highs. That's a bit of a relief. And even globally, the fact is You had, almost 24 central banks cut interest rates over the last few months. So hopefully the global outlook won't be as gloomy as one had thought. So we have to look for, signs of hope wherever we can find them.
All right, Sajjid, let me then ask you about whether you're hopeful that any of the steps taken by the government will help, or do we at this stage need broader fiscal stimulus either through tax cuts or through spending?
On the fiscal front, ideally, this is the environment where monetary policy efficacy is reduced because of heightened risk aversion on the part of financial intermediaries that would call for a counter-cyclical fiscal push to break this negative cycle. Of course, as we've discussed before, there is no obvious fiscal space, and the government has, to its enormous credit, exercised strategic fiscal restraint. But there is one thing they can do, and I think we're hopeful that that will happen, which is to really front load or to double down on asset sales. Because as we've said this before, to the extent that you can meet your fiscal deficit target, keep to the same target so borrowing requirements don't change, but to the extent that you can meet them through more and more asset sales, the effective fiscal impulse for this year will be larger and more expansionary. And I think that's the one bullet that can still be fired, that we should meet that disinvestment target. Ideally, you want to exceed that, and the fact that the RBI extra dividend is about 0.3% of GDP also means even if you stick to the same fiscal deficit target, the fiscal impulse, which impacts growth, could actually be positive. So the hope is that in conjunction with slightly better easing of monetary policy in the coming months could provide some counter-cyclical support.
In the current environment, do you see no argument for allowing the government to take a wider fiscal deficit for the current year and then maybe coming back to the predetermined trajectory later?
Well, I don't want to be overly prescriptive here. It's a difficult time, and the government, to their credit, has tried a variety of things. For me, the concern is not so much ideological. Fiscal policy is being used in different parts of the world. It's more, what will the impact of the bond market be? What you've already seen is, just look at the term premium in the bond market. The overnight rate's at 5.4%. Swap markets have priced in more rate cuts, so expectations are more easing will happen. And yet the 10-year bond is trading at 660, or it was even went up to 670. That 130 basis point spread or term premium reflects some of this fiscal overhang. And so for me, the concern is that if the government were to legitimately say that the deficit needs to widen, then and borrowing requirements go up domestically, that just puts more pressure on the long end, and it further impedes the efficacy of the RBI rate cut. So that for me is the concern, that any fiscal expansion is counterproductive to an extent because it makes the monetary transmission even more imperfect.
What about monetary policy? Do you think there is need for a steeper than 25 basis point cut at the next policy? And where do you see rates stabilize in the current cycle?
So we do expect at least a 25 basis point rate cut in the cycle. Ideally, I think what the RBI should do is keep doing small increments, because because that's what keeps bond markets interested. If you do a disproportionately large cut and markets feel that you've exhausted space, ironically, that gets you less transmission, as we saw after the August policy. I think there are a lot of moving parts here, but given our own models of where the output gap is, if one assumes that oil settles at current levels, 63, 64, and inflation in the first half of next year is still modestly below 4, I think the central bank still has room at least to go to 5%, which means another 40 basis points of cuts from here. I think after that, it'll have to be very data dependent.
Sajjid, thanks so much for joining us on Bloomberg Quint.